So hello, my name is Larry Smith. I've been a portfolio manager, chief investment officer, and chief executive officer for nearly 4 decades. And the markets continue to intrigue me, especially now. Winston Churchill once said that those who fail to know history are condemned to repeat it. With that in mind, I'd like to take you back to March 9th, 2009, where the skies were as dark as they had been since the Great Depression. On that day, the stock market troughed, down another 1% to 676.53. Yes, 676. Since that dreadful day, the S&P 500 is up almost exactly fourfold to around 2,700. The annualized total return to the S&P over that time period is 17.7% per year for nearly a decade. Wow. By way of contrast, the previous bull market provided annualized returns of 15.5% per year, but since it was only for 5 years, the cumulative return was 108%, or about a third of what the current bull market's run has been. And the one before that, remember the golden years in the 1990s? Well, that was up 24.3% per year for around 6 years, for a roughly comparable 283% cumulatively. And we know how that bull market ended. So buyer beware here. Credit markets have followed a similar path. A decade ago, high-yield bond spreads peaked a bit earlier than the stock market on December 16, 2008, at an option-adjusted spread of just under 20%. That's right, just under 2,000 basis points. In sympathy with the stock market, they troughed a second time, also on March 9, 2009, at just under 1,700 basis points. They're currently trading at a little bit over 400 basis points after hitting their cyclical low of 303 basis points just about 2 months ago. No surprise that debt funds, especially those which are levered or play in highly illiquid segments, have generated such attractive returns. And of course, the economy followed suit. The Great Recession officially ended in June 2009, about 3 months after the stock market troughed. And while economic growth has been below rates of previous cycles, they've been consistently positive, allowing corporations to generate good earnings growth. This has led to valuations that are reasonable given where inflation is, with the S&P currently trading at 16.5 times forward earnings. And that's about the highest valuation of any of the major stock markets that we follow. The Eurozone, by contrast, is trading at 13.4 times forward earnings, Japan at 13 times, and the emerging markets at 12 times. None of these valuations are cause for concern by themselves. What is of concern is whether the economic cycle is about to head south. So what could cause this to happen? The most obvious change in the economic backdrop is coming from the Federal Reserve, which introduced quantitative easing on November 25, 2008, when it announced it would purchase up to $600 billion in mortgage-backed securities. This was a bold move that was made necessary by the reality that it really doesn't make any sense to reduce short rates below zero. With that constraint staring them in the face, they moved to get other rates down by injecting liquidity directly into other markets, especially the crippled housing-related markets. And while it didn't work overnight, and while there were bumps in the road, it was largely successful, especially when combined with massive fiscal stimulus. The Fed expanded its balance sheet from $900 billion in 2008 to $3 trillion in 2012, paused for a bit, and then resumed their balance sheet expansion to $4.5 trillion in 2015. That's a lot of money, even for a $19 trillion economy. But not to be outdone, the Bank of Japan expanded their balance sheet from around $1 trillion to around $5 trillion. And the ECB went from $2 trillion to around $5.5 trillion. The one thing we know about central bankers is they live in fear that they will lose control, and they weren't about to let that happen, even in the face of a calamitous global credit market collapse. While it took a while, economies largely recovered, stock markets soared, and the world's banking systems were restored. Mission accomplished for the moment, because eventually a growing economy was going to cause problems of its own, and it has. The unemployment rate has gone from a cyclical peak of 10% in October of 2009 to a current level of 3.7%. Now, Economists can argue until they're blue in the face about which unemployment rates make the most sense to focus on, but to me it matters not. The cycle has gone far enough to use up the vast majority of available labor. And while globalization can keep a lid on wage pressures, just take a look at the most basic of all labor inflation rates, average hourly earnings, which has risen remarkably steadily from the 2% level in 2010, 11, and 12 to its breach of 3% in the most recent release containing October's numbers. I will note that unit labor costs have been quite steady, but there's a reason why. Fiscal stimulus from the recent tax bill has boosted growth, leading to higher levels of productivity. This has offset the rise in average hourly earnings, but as that stimulus wears off, and it will, we'll be left with rising hourly earnings without the productivity offset. The bottom line is inflation pressures are brewing, and the Fed is well aware of this. The Fed is also aware that policy decisions take a while to have an impact. Quantitative easing may have ended in 2014, and the Fed has moved slowly to reduce the size of its balance sheet, which now hovers just above $4 trillion. That might still sound like a lot of artificial liquidity, and it is. But remember that markets are affected by what happens on the margin. And on the margin, the Fed is removing liquidity. This is most evident in the level of short-term interest rates, which have gone from basically zero to around 2.25% today. But as important is what's happening to the rest of the yield curve. 10-year bonds have risen to around 3% from their cyclical trough of 1.36% in 2016. And if the economy can keep growing as it has, well, with inflation at 2 to 2.5%, a normal level for the 10-year bond would be more like 4 to 4.5%. Yet that's not what I'm forecasting because, as Lee Corso says on the weekend college football program, not so fast. I cannot remember the type of fiscal stimulus that the last tax bill contained coming so late in an economic cycle. While it helped growth short-term, over the intermediate term, it feels more like pushing on a string. And while trillion-dollar deficits might not scare anybody anymore, the notion of a trillion-dollar deficit occurring so late in an economic cycle should ensure that we don't see another massive fiscal stimulus bill coming out of Washington anytime soon. So call me bearish about the economy. And if there's one thing I could be sure about, the financial markets will get there before we see it in the economic data. We've already started to see this. The S&P, which has clearly been the best performing major stock market of the year, is off 7% from the end of September, bringing its year-to-date returns to around flat. Other stock markets have followed suit, all the more damaging because they didn't have gains from earlier in the year to cushion the fall. Many are down 10% for the year in local terms and several percent more in U.S. dollar terms as the dollar has strengthened quite a bit this year, not a surprise as it's been the best economy of the major economies of the world. Volatility as measured by the VIX is above 20% after troughing below 10% a year ago. Credit spreads have started to widen. If you want to see a scary chart, take a look at the investment-grade 10-year bonds maturing in the years 2019 through 2022. There's a lot of refinancing coming, and it's going to be a big problem. My point is that on the margin, there are mounting reasons to get concerned about the financial markets, not less. And while we've seen a correction in risk assets, it's a mere pittance versus the type of correction that would be associated with a more significant slowdown in economic growth. I'm not forecasting the type of gloom and doom that existed a decade ago, but looking out over the next 3 to 5 years, the types of long-only strategies that have done spectacularly well are likely to rank near the bottom of the list going forward. What goes up must come down. The challenge is to know when. And it feels like now is the time to seriously reposition portfolios. Maybe we'll get a bounce back of a few percent or even to the recent highs, but that's about the best scenario that I can conjure up. If you want to be optimistic, you could look at the yield curve and feel good about the fact that we still have a positively sloped curve. History might support the notion that we have a bit more time before the bottom falls out, that we're in the 7th inning, not the 9th inning. And to be clear, the Fed reverses their position and puts higher short-term interest rates and further shrinkage of its balance sheet on hold, then I think risk assets are okay here. Not good, but okay. But I'm not betting on it. Why should this Fed's crystal ball be any better than those of previous Feds? Remember when Greenspan retired and announced that he was leaving the Fed knowing that short-term rates were now neutral? Well, Bernanke came in and raised short-term rates 3 times after that. and that wasn't such a good decision, was it? Greenspan himself raised short rates 6 times from mid-1999 to mid-2000, the last time by 50 basis points. That wasn't such a good idea either. It's not that the Fed is bad at their job. I actually think they're very good, but they're not perfect. And given the leads and lags from monetary policy, combined with factors that are outside of their control, at the very least, we shouldn't expect them to do what's never been done before. Economic cycles come to an end, and my sense is this one isn't very far away from coming to its end. I don't mean to be alarmist. Again, I'm not forecasting the type of calamity that took place a decade ago, especially in the equity markets, where valuations don't scare me as they have at times in the past. A significant correction of 20% or more would take the type of unexpected implosion of liquidity that we saw from the housing and mortgage markets a decade ago, and I'm not aware of anything so vast as at risk today, with the possible exception of Chinese banks, which have been a risk for as long as I've been managing money. Yet I do think investors should be looking for strategies that really do provide uncorrelated alpha, especially given the reality that a bear market for one risk asset is likely to be a bear market for all risk assets. Portfolios should be long alpha, not beta at this point in time. Given that, a reallocation in the direction of alternatives should be explored. Which alternatives? To begin with, equity funds that truly do focus on alpha, with betas that typically run close to zero, could do quite well in this higher volatility environment. Unfortunately, most equity long-short funds tend to be perpetually long, with betas closer to 0.5, so please be on the lookout for this type of implicit market exposure. Many credit funds have done consistently well over the recent past, but they can be even worse than equity funds regarding their tendency to be very long. Momentum strategies, such as many CTA strategies, which have done generally quite poorly since their sterling 2008, well, those guys could be in store for some good returns and will offer true protection against a significant bear market, much as they did in 2008. But what gets me most excited right now at this point in time are strategies that have nothing to do with the markets in general. I'm thinking about life settlement funds and litigation finance funds in particular. And I'd also throw in a good word about venture capital funds that invest money over a period of several years, as a market downturn will have an immediate effect on the ability of small companies to raise capital, allowing venture capital funds to invest in emerging companies on an attractive basis. Thank you very much.